Hey traders, welcome to 2022 and the 2022 FX and commodity and crypto market update. We're going to run through a couple of charts which kind of represent what I believe the markets are going to be doing this year. A lot of it's got to be centered around what I think is going to be the Chinese debt crisis playing major havoc on the markets moving forward through the rest of the year and probably into next year and potentially beyond that. But yeah, a couple of charts which represent that and why I believe we're heading back to a deflationary environment, and I still remain on team transitory. We will see why I believe that, because it's all in the charts. That's how I run, that's how I operate. The charts tell me everything I need to know. So far they've been spot on. As you've seen from our 2021 market update, pretty much everything we put in there came to fruition. And you can watch that here, and you will see that is still kind of applicable right now, because things take time to play out. These longer term forecasts, things from 2021 are still playing out. We're still seeing that turn in the markets. We're still seeing a shift back towards a kind of deflationary environment, and I believe that started to occur kind of from August onwards, but really started to accelerate into the end of the year. So let's run through some charts and just show you exactly what I'm talking about and why I believe we're in for a little bit of a debt crisis moving forward, potentially more than that, and why we are heading back towards a deflationary environment. So let's get into it. So the first chart I want to look at is the gold-silver ratio, which is basically a good representation of monetary inflation. So in monetary inflationary conditions, we will see silver outperform gold, which means we'll see the gold-silver ratio drop. That's what we saw in Q1, where we saw the global financial crisis. We saw central banks respond with a inflationary or monetary inflationary impulse, and that led to the gold-silver ratio declining over the next 2 years before we had the European debt crisis. Then when we had the European debt crisis, gold started to outperform silver as we went into that kind of deflationary monetary breakdown, or breakdown in the monetary system following that, and that basically lasted 10 years as we went into kind of more tighter liquidity moving forward. So basically, if we look at it like this, when you see silver outperforming gold, there's a lot more liquidity in the system. When gold is outperforming silver, there's a lot less liquidity in the system. And when we head over to what happened in recent events, we had COVID QE, we had obviously had a massive monetary response by the Fed over the COVID pandemic. We saw a massive drop in the gold-silver ratio, pretty much equal to what we saw during QE1, big inflation expectations, monetary inflation expectations in particular. And then we saw that kind of bottom out heading into January, March, the beginning of 2021. And since then, we've seen a pretty strong rise in this gold-silver ratio, basically up as it stands 30% from the lows, which to me is a good indication that we have seen a turn in those monetary conditions, and that kind of monetary inflation that we've been seeing of late is over. And I believe that has to do with the Chinese property market coming to a halt, a little bit of a bubble bursting there, and it's pretty much what we saw with the European debt crisis. We're just now seeing a Chinese debt crisis, which is going to have massive implications for global commodities, for global inflation, global economic output. And that's what we're seeing, especially in the monetary proliferation of credit. We're seeing the gold-silver ratio now turning back up as gold starts to outperform silver, and liquidity begins to tighten. When we move over to the copper-gold ratio, this is an indication of actual economic inflation. So when central banks are looking for inflation, it means they're looking for economic growth that is kind of a underlying driver of inflation. That's why they kind of miss the boat when they talk about, oh, we just want to push inflation up. If you don't have economic growth with that inflation, you just end up in a stagflationary environment, which eventually leads to deflation. And this is what we're seeing now in copper gold, where if copper is outperforming gold, you're seeing economic growth, you're seeing a good burst of economic growth, you're seeing demand. At the very least, you're seeing expectations for demand for copper, demand for that economic growth. And what we saw back in 0809, obviously, we saw the global financial crisis, which actually started to kind of take hold back in 2006, but really started to take hold in 2008. We saw a massive drop in the copper gold ratio. Basically, copper was dropping or just dropping much faster than gold was. And this is exactly what we saw in 0809. In 09 to 2011. It's that QE inflationary expectations. The global markets start to see inflation. They start to believe that it's actually driven by economic growth as a result of inputs by central banks. And you see this kind of expectation of inflation pushing the copper gold ratio up over that period. But then we hit into, again, that European debt crisis. The market suddenly realizes that, well, that economic growth that we were expecting isn't actually there. And then we go into basically a 10-year bear market with the copper gold ratio, 10 years of economic slowdown, with a couple of obviously short-term bursts in between that, in 2011 to 2013 and 2016 to 2018. That's where we started to see the hiking of rates by the Fed, which obviously led to, again, that deflationary drive lower. So copper gold ratio kind of showing that same thing. We saw this QE response with inflation expectations drop or climbing really steadily. We saw an increase in the potential for economic growth, which I don't believe is actually going to be there. It's more of a recovery to below the baseline where we were before COVID, because we were having a declining global economy before COVID. And now what we're seeing are those inflation expectations potentially rolling over, and then once again heading into that deflationary environment, similar to what we saw following the European debt crisis. So we can see something similar, and probably push a lot lower than that, below the lows of March 20 before COVID. That's what I suspect is going to be happening over this year. And when we look at the daily chart, we start to just analyze what we're seeing on price action here. Classic Chartists will look at this as a kind of classic head and shoulders pattern, busy forming the right shoulder now, and once that kind of neckline breaks, we will see a drop in the ratio, and obviously that's going to be an indication that what we're seeing is basically a deflationary environment, lack of economic growth, and kind of trouble in the global economy. Again, why I believe it's going to be driven by China, and why I believe that, just from a charting point of view, if you guys have seen our videos, we've been talking about China on our weekly game plans, our weekly global macro breakdowns. A lot of it's been about China, what's happening in that sphere. So you can go back and watch those for kind of the headlines. But when we look at the charts itself, it's pretty clean and clear picture, where we have a nice big impulse from 2014 all the way up to 2017 before we start to go into Trump's devaluation of the dollar, where Trump started talking down the dollar heading into January 2017 all the way down into kind of March 2018, where we had the Fed starting to hike rates, and we saw obviously a big jump in the US dollar versus the renminbi. Then we had COVID, we had that massive response from the Fed, huge amounts of liquidity being pumped into the system, and that drove the renminbi back down to those kind of March 18 levels. And what I'm seeing now, what looks a lot like a descending wedge out of this bigger ABC corrective structure, which may start to see the US dollar outperform the renminbi, and we see the US dollar coming back above 720, back to those old highs that we saw back in 2019 and 2020. And what that makes sense, because if China's economy is going into the slowdown as a result of their property crisis, their property breakdown, basically the property bubble popping, we are going to see them weaken their currency to remain competitive in the global environment and try to boost their economy through exports and go back to that export economy, because that's where they can get economic growth, where they can compete on the global scale. But in order to compete, they need to weaken their currency, and that's what I believe is going to be happening moving forward into 2022. And how this whole story unfolds is the CRB index. Obviously, if we go to the CRB index back in kind of QE1 days, we saw that same thing. We saw that inflation expectations pumping commodities higher all the way up to 2011 before we got into the deflationary trade, the European debt crisis, which then resulted in a 10-year bear market in commodities all the way into the COVID pandemic, before we had supply chain shortages and a huge amount of liquidity being pumped into the system, talks of inflation, etc., etc. Basically the same old story that we saw from QE1, massive inflation expectations through QE infinity, which pushed commodity prices basically huge amounts, up 135% over the course of basically 18 months, maybe a little bit longer than 18 months. And now we're in that region where once again we're going to be pushing towards a deflationary trade as the China deflation, the China debt crisis starts to take hold, and we see commodities drop. Because if the Chinese property market, which is a massive market, starts to break down, the demand for commodities takes a massive hit. And if that demand for commodities takes a massive hit, along with what we've seen in inflation expectations, you will see that a lot of the markets are going to be oversupplied. Because what these suppliers will be doing is buying as much stock as possible to hold on account or in the inventories, because if you buy it now and you hold it for a couple of months, you can sell it for twice as much as it is now, because that's what's been working over the last 18 months until that stops working. And when that stops working, we see that these guys are going to be oversupplied. They're going to want to dump their stock onto the market, and when they start dumping stock, you're going to see a big drop in commodity prices, which may have started already. I kind of suspected it was started heading into the end of the year, when we saw this massive drop in prices from basically October all the way down into the beginning of December. But throughout December, we had a little bit of a resurgence, and we're heading back towards the highs. But regardless of that, on the lower time frames, the higher time frames show that we are in that sell zone already. We can push all the way up to 270. There's still a little bit of upside potentially there, kind of 10-12% upside. But what the chart says to me is that we are near the highs of this commodity boom, and we're going to start to turn back down into that bear market, and we're going to see potentially a fairly long drawn out bear market. I wouldn't call it a 10-year bear market, maybe heading into something like 2025, 2026. We should see commodity prices below those pre-COVID levels just before COVID hit. The supply chain issues became a problem. And again, once we solve the supply chain issues, it's just going to exacerbate the problem, because you're going to find people are overstocked, people have paid too high prices for their stock, and they're going to want to start to dump as soon as possible. And that's going to see a massive turnaround in commodities, which is going to be a massive indication that we're heading back to that deflationary trade. And when we look at the dry Baltic index, we're seeing that same thing. Basically, the Baltic dry index is a cost to ship goods around the globe. It's the cost of shipping dry goods, which is like your corns, your grains, things along those lines. But just basically speaking, it's a cost of shipping around the globe. When we saw the cost of shipping plummet back in 08-09 because the global economy, the global financial crisis hit, we saw a massive downturn there. Previous to that, we saw these big increases as a result of basically oil shortages. Nigeria was an issue. The Iraq war was an issue back then. We saw US gas prices rising as they were having gas shortages. So we saw this kind of 3-4 year, or 2-year rise in the Baltic Dry Index before we saw that massive turnaround as the global financial crisis hit and everyone realized that the global economy was in massive trouble. Then we had that QE response, that inflationary response, Baltic Dry Index climbing all the way up to 47 from around about 629. So it's a really big climb. It doesn't look like it on this chart, but it's a good 600% increase before seeing that turn around, going back to basically that standard level of what it costs. Because in a general normal economy, you'll see the price basically hover in this region here. Then we had COVID hits once again. March 2020, supply chain issues, oil issues, etc., and we saw a massive increase in the cost of transporting goods around the globe, a 1,600% increase to be exact. But since then, we've seen a good 60% decrease. So that's just showing us that these supply chain issues are being solved. We are seeing the oil prices kind of normalize. Oil prices were climbing all along this period here, pretty much tracking the Baltic Dry Index. Baltic Dry Index has rolled over, and you might find that these guys are oversupplied in oil, and that's why we might see the oil price drop moving forward. That's something I have an eye on over 2022 as well. Everyone believes that oil is on the rise because we've underinvested. That has been the case, but I believe that that is going to turn around in 2022. And we will see crude oil begin to drop. And again, it's that same narrative. We go back to global financial crisis, massive drop in price of oil because there's no demand for oil because the global economy is on its knees. Then we have the QE response from central banks. We have talks about inflation expectations, growth expectations, money getting pumped into the system that's going to create economic booms, pushing the price of oil up all the way from basically 20 or 34 a barrel all the way up to $130 a barrel. Then we see this double top in oil. We saw this kind of pretty decent decrease in a short period of time, 30% decrease in 2012. Then we started to chop sideways, and then 2014 hit, and we saw a massive decrease in oil all the way down to the lows, 18th of January 2016. Then we saw a little bit of a resurgence, and then another test of the lows, and all of that was part, basically you could look at that as a 10-year bear market with a little bit of resurgence in the middle. And then again, you look at Fed rate hikes in this region, and that was close to the high for oil moving forward. So if the Fed's talking about raising rates this year, 2022, we can expect the same response in oil moving forward as the global economy starts to roll over. And that's exactly what the charts are saying. We're seeing another leg down in oil, back down sub 15, back down below COVID levels, as basically, again, everyone's going to be oversupplied in oil because they've been stocking up on oil, believing that oil is going to continue to surge. Everyone's talking about $200 a barrel in oil because of supply chain shortages, etc. Once that gets solved, we see that there's a massive oversupply of oil, and oil starts to hit the market at a rapid pace, and we see sub 15. And obviously, we could even go negative, as we did when the US WTI went negative. Back in 2018, 2019, I believe it was, 2019. So we're seeing the same thing across the board. All these charts are showing congruence. When we look at copper, obviously a great indicator of global demand of metals, of economic growth. When economic growth is really strong, you have huge amounts of growth in copper because there's a massive demand for copper, because there's a demand for electronic goods, which shows the demand as a result of economic growth. But when you see a massive decrease as a result of the global financial crisis, you have expectation of economic growth as a result of QE pushing prices higher until the reality sinks in that we have the European debt crisis and maybe the economy isn't as good as we think. And then we have a 10-year bear market once again. A little bit of a resurgence in the middle, but again peaking out right when we talk about rate hikes by the Fed. Then we drop out down towards the lows of the coronavirus. Again, QE, inflation expectations, monetary inflation, money printing. Copper starts to rally extremely strongly, exactly like we saw in 08-09. And then again, if we see that Chinese debt crisis start to take hold, as I believe it will, we're going to see the exact same pullback that we saw in 08-09. It's a global financial stress, global financial stress in the economy that's going to show this copper price from where it is now. I believe we're going to see a good 60 to 70% decline in copper prices over the next 2 to 3 years moving forward. And then again, when we go into lower time frames, you have that same head and shoulders structure that's formed, a little bit more of a complex head and shoulders structure. The right shoulder looks to be done to me. We're still breaking down. And when we look at things in terms of how I analyze charts, we've already had the breakdown from the highs. We've gone into a shorter time frame consolidation. We should see copper prices start to decline fairly shortly. Maybe get one last rally as this E wave unfolds. That's a nice big ABCDE expanding triangle, also known as a break and retest of the head and shoulders neckline. And then we're going to see that decline moving forward, and we'll see copper prices dropping kind of sub 1, I believe, moving forward. Not sub 1, excuse me, around about 150, I would say, which is a massive decline. Moving on to platinum, same thing in platinum. 2008, 2009, massive increase in expectations of economic growth. Precious metals rally strongly under the news. Also monetary inflation. We hit the European debt crisis in 2011, and that just leads to a massive decline. A couple of bounces in between then and there, all the way down to the coronavirus, where platinum was sitting at 568 an ounce. Then we had that same monetary response. We saw copper or platinum prices more than double from where they were to the highs, 132% higher at 1336 per ounce, where I believe we've seen it top out. And then again, when we look at the structure, we're seeing an impulse off the highs, an ABC, which is what we call a big running flat, and confirmation of the running flat thus far with this big move lower, and this should continue lower. So we've been short platinum from November, as we believe this is already starting to play out. And again, it's demand for platinum in the vehicle sector in China. But if the Chinese economy is in a massive slowdown, there is no demand for that platinum, and you'll see a massive slowdown or massive drop in platinum prices. Same with gold. Gold, as we can see, 2011 European debt crisis, you would expect gold to rally under debt crisis because it's considered a safe haven status, but the dollar actually starts to rally, which puts pressure on gold. And when the dollar rallies, we see gold push down. Basically, we saw it from 2011 all the way down to 2016. We saw a 45% drop in gold over that period. Then obviously we went into a little bit of a resurgence in gold, but pretty much stable in this region, forming a little bit of an inverse head and shoulders before the coronavirus hit. Even before then, we started to break higher, and we saw gold rally pretty strongly all the way up to new highs at basically 2080. But the chart itself is saying to me that this is a big ABC corrective structure. And if that isn't a big ABC corrective structure, we could see gold all the way down to 1200 before it takes off. And when did we last see that? Well, we last saw that during the global financial crisis, where we saw gold drop 34% from the highs all the way down to the lows in 2008 before turning to the upside and gaining its safe haven status. So again, if we look at a 35% drop in gold from the highs that we saw now, we're dropping right into that area at 1345, in that area where we believe gold is a great buy. It's not a great buy now. I believe we're going to drop from here. It's going to be a bumpy road, but throughout 2022, I believe we're going to see decline in gold prices. But it's not going to be declining as fast as silver, because as we said, if we look at silver-gold ratio in these conditions, silver is going to underperform gold. And when we zoom out in the silver ratio, let's go all the way out to the monthlies. You can see here the monthlies are showing that same ABC corrective structure, where you have a big A wave down, silver topping out at $50 back in the 80s, dropping all the way down to 1991 at $3.45. So massive decline in silver, 92% decline before rallying back up to those highs at 46 between 1991 and 2011. Then again, European debt crisis hits, and we have this massive decline over the next 4 or 5 years. A little bit of a rally in between, but we basically bottom out during the coronavirus. Then we see that massive money printing response, and we see silver prices rally all the way up to $30 from that $11 low, basically 163% increase in silver. And everybody starts to talk about 3-digit silver, $100 silver, $1,000 silver, etc. But it's all part of a structure that represents a short-term bounce up to this $30 region. But once we see the second debt crisis, or the Chinese debt crisis, and we see so many participants on the wrong side of the market start to dump their silver, I believe we're going to see silver heading sub 10, more than likely down into the low 10s moving forward, before we see a turnaround. So silver becomes a great buy in the sub 10 region. If you can get it all the way down to $3, that's an amazing buy. But this is basically the buy region. Once we get down there, we will see that as a great buy. But before we get there, there's obviously a lot of turmoil. We started to see an end of the year where silver really started to drop, heading into kind of November into December. But we already saw it peak back in February, in January, February, where we called for the top in the dollar. The dollar started to turn, silver started to drop, formed this perfect running flat corrective structure, confirmed that running flat. I believe we got into a little bit of a corrective structure here, and when we get under this region, basically going to see silver drop through a massive hole, because when we look at the volume profile in this region, you can just see how there's just no volume available sub 21 all the way down to 18, because that's when silver really rallied into Corona. There's no market in this region, and we're only going to find a market once we hit kind of 18 again, and only once we get down there, I believe it's just going to be sellers, and we're just going to see silver basically continue to fall and to go sub 10, the same levels that we saw pre-coronavirus. So you can see how all these charts are aligned for that same narrative to play out. Heading into currencies, we see the same thing. The Aussie dollar, US dollar, obviously commodity currency is going to take a massive hit. When we look at the structures of these currencies, we have a really nice big impulse off the highs from, you guessed it, 2011 all the way down to 2016. You have that coronavirus, that European debt crisis smashing commodities as a result of lack of economic growth. You see some rebounds here and there until we get up to Fed rate hikes 2018. We see a big drop in the Aussie till we get into the coronavirus region. And once we get into the Corona region, we start to push higher as we start with the money printing situation. Talk of inflation. Inflation pushes commodities higher. Commodities push commodity currencies higher. Aussie dollar rallies. But I believe we've seen a top in the Aussie dollar moving forward. We've already been short the Aussie dollar from August 2021. That's really starting to pay off now. And as you can see, got that same structure, impulse off the highs, beautiful ABC running flat, and confirmed with a nice big pullback from there. A little bit of a zigzag correction here. This should start to move lower heading into the beginning of the year. And we see the same thing across the board in commodity currencies. Moving on to New Zealand dollar, US dollar, you see the same thing, just a beautiful running flat structure. Nice strong move to the downside, nice running flat. And then in the lower time frames, you see a high, big impulse off the highs, beautiful running flat, and then confirmation of that impulse to the downside. And this should continue to move moving forward. We see the same thing in the CAD, where we saw again coronavirus hit in that 2020 region, same peak that we saw in 2016. Now we pulled all the way back down. Nice, just one of my favorite charts, just a perfect structure, huge impulse, nice long drawn out ABC corrective structure, everything we like to see in a correction, and then we just turn from the perfect region to the upside. From 120, we touched all the way up to kind of 130, 129.50. Seeing a little bit of a response in there. I believe we're just going to be in correction here for a little bit longer, and then we're just going to push higher back to new highs in the US dollar CAD. Obviously we should see emerging markets take a hit as well moving forward, because if China is going to be smashed by the debt crisis, it's going to expand across Asia, very much like what we saw during the Asian financial crisis, and what we saw again in the global financial crisis. You saw this massive drawdown. You saw a nice long drawn out B wave corrective structure. Again, just a perfect structure in what we look for. But what's missing out of this one is a C wave to the downside that will look like it'll match the A wave. And that's pointing towards, from where we are now over the next few years, a good 55 to 60% decline in emerging markets in EEM, the emerging market ETF. So watch for that to play out. And just as we said, Hong Kong is another one, the Hang Seng, showing that already. We started 2021 bearish the Hang Seng from this region here, saying you guys need to be careful with the Hang Seng. It's looking ready to drop. And over the course of 2021, we saw a 27% decline. That's going to continue. I still believe we're going to see another 40% downside here before we bottom out in the Hang Seng. And that's obviously all, again, related to China. You can just see how all these markets are interlinked in this way. We're going to the Turkish Lira, emerging market currencies. Turkish Lira already starting to get hammered, heading into September. Basically, it started. This is another one we called for. We called for the decline in the Turkish Lira, a complete blowout, and that's exactly what we had from March 2021. We saw the Lira peaking in 18. There was a massive response from Turkish Central Bank, but that has been short-lived, and we're already sitting back at that 1380 region, and that should continue to weaken. So the Lira has already started to move, but we should see, I wouldn't say as bad, but similar moves in something like the Mexican peso. Again, if we go all the way back, we have QE1. Inflation expectations. Emerging markets perform well during inflation expectations and potential economic growth. We saw the peso decline all the way into 2011. We see the European debt crisis hit in 2011. A little bit of resilience all the way up to 2013 before the peso breaks out pretty strongly all the way into 2017, where Trump starts to talk down the dollar. Then once again, we start to push higher, and coronavirus hits up in this region here. We see a massive blowout of the peso. We saw central bank response once again, and we saw the peso weaken all the way back down. We see that same thing. This basically the weakening of the peso, of the US dollar versus the peso. It's that same move that we saw from QE1. Very, very similar, a lot quicker because a lot bigger response, but at the same time, only temporary. I believe we've bottomed out in the peso in 2018. We should see a little bit more downside heading into January, but I think by February we should see this turn to the upside, and the peso will go plus 25 and beyond, probably into the 30s, heading into the end of 2022, maybe the beginning of 2023. US dollar ZAR, same thing. South African Rand. Let's just go back. Nice little history lesson. Global financial crisis. Huge blowout in the Rand from 644 all the way up to 1149, basically a doubling. Then we saw QE1, QE response, money printing, emerging markets do well, commodities do well, Rand does well. Go from 1149 all the way down to 652. European debt crisis hits, emerging market currencies get hit because of global growth, and we see the Rand go from 650 all the way up to 17 over the next 5 years. Trump starts talking down the dollar, Rand recovers slightly, gets all the way down to 2018. Powell starts hiking rates. We see a blowout. We see a little bit of a corrective structure. We have the COVID hit in 2020, basically in this region here. And we see the Rand blowout all the way from 14 all the way up to 1960. Then once again, we have that same QE response. Inflation expectations, commodities rally. The Rand does well, goes from 1934 all the way down to 1343 before turning back to the upside. And then already zooming in, you can see how much we've climbed from those lows in May 2021, now sitting 21%, or not where we are now, getting as high as 21% higher, sitting now at 16% higher, I believe, just correcting for another leg up, with price targets on the Rand, US dollar ZAR being around about that 24 region moving into 2023, 2024. So we're just seeing that same pattern over and over again. South Korean won. Let's just go back all the way to the monthlies to show you what a Asian financial crisis looks like for the South Korean won. Starts off really slowly. This wasn't really part of the Asian financial crisis. The financial crisis hit here in 1995 in that area there, and we just see this massive blowout in the US dollar versus the Korean won. Then we go into this long, drawn-out corrective wedge. If you are a classic chartist, you will see a beautiful little pennant or little flag or triangle, however you want to look at it. And from that, once we start to break out of this triangle, you can see the Korean won basically doubling from where it is now, getting all the way up to potentially around about 2283 to the US dollar, much higher than it was at the peak of the Asian financial crisis. And again, if we start to look at the year, it looks to me like we are starting to break out of this triangle, getting close to breaking out of that triangle, heading into 2022, and this should start to break higher moving forward. So you can just see how what we're seeing is a very high potential of a European debt or of a debt crisis, global financial slowdown moving into 2022. And then Bitcoin and the crypto space. How this is going to affect Bitcoin and crypto, I'm not 100% sure. I believe initially it should sell off. Bitcoin should sell off as part of a crisis, part of a debt crisis of an economic slowdown, because it is still a speculative asset. But this is actually a part where it could actually start to perform as what it's meant to perform as, because when the peso is blowing higher, when the rand is blowing higher, when all these emerging market currencies are blowing out, and you have millions of residents who have to find a way to protect their savings because their currencies are being debased and just being smashed by the euro dollar situation, the shortage of dollars in the system, Bitcoin becomes that safe haven for those people. So initially, I believe we should see a sell-off, but eventually we should see another leg higher moving forward. How that sell-off is going to play out is whether you think log charts are going to work, which technically they should, which means you should see Bitcoin US dollar basically dropping like it did from 2017 into 2018, which means sub 20 Bitcoin US dollar. If they don't, we are looking at the lower time frame structure, this big ABC corrective structure, which I'm kind of leaning towards more than the other for now. But even if that is the case, we should see 40,000 break, and we should go down to around about 29,000 before taking off from there to the upside. That's kind of what makes the most sense to me, but there may be a bit of bias in there just because of how crypto performs, and how it's just been in this long upward trend for so long that it's kind of hard to believe that we're going to go down sub 20 once again. It is possible. I still think it is on the cards. I would say there's a 30% chance we go sub 20, a 50% chance we go sub 30, and whatever's left over out of that, we might see a bounce from this 40,000 region, because we have done enough in terms of price action to start to move higher from here. It'll just be more of a contracting flat more than anything else. But I do believe we should see into this region and move down sub 30. And maybe sub 20, like I said. Same with Ethereum. Lower time frame structures indicating that Ethereum is going to get kind of down towards 2200 before taking off from there. That's a lower time frame running flat. But if you go out to the higher time frames, there's that possibility that we see Ethereum drop below this 1500 region to complete the structure and then take off from there, which to me just seems quite unlikely. But hey, in the crypto space, nothing really is unlikely because anything's possible. So we'll just have to see how that is going to unwind, how that's going to unfold, and what the crypto space is going to be doing heading into 2022. It's cool, guys. As you can see, that narrative that we are heading into a deflationary environment is being heavily supported by what I'm seeing in the charts, being quite well supported by the fundamentals coming out of China and what we're seeing over in Asia. And I believe what we're going to start to be seeing heading into 2022 is that deflationary move, the Chinese debt bubble breaking the global market, seeing a global economic slowdown, Powell hiking rates, adding to that pressure. And yeah, things I think are just about to get pretty ugly over 2022, 2023, 2024, but some great opportunities on the cards. So some great trades available to us if we can trade against those markets in a big short kind of manner. So members, we'll see you in the members area to get set up for that. If you're not a member, please take a look at senecalytics.com. I'll put a link in the bio. You can join our investor guidance service where we look at long only shares that you should be buying, or you can join our trading academy where we run you through exactly how we analyze charts, teach you everything we know, and then give you daily updates on those markets and the trades you should be looking at. That's our flagship service. And then if you are in institutional, we have some institutional research that we put out as well, and you can find those links on the website, and you can get hold of me for that. It's cool, guys. Hope you have a great year. I hope you stay nimble because things are going to get bumpy, and I hope you stay with me on this journey so I can help you navigate these treacherous times moving forward. Have a great year ahead, and we'll see you soon for another market update, another global macro breakdown. So keep well. Chat soon.